Today on Elliott Wave TV, I'm joined by Jeffrey Kennedy. He's joining me remotely from his home office in Florida. Jeff is the Chief Commodity Analyst for Elliott Wave International with 20-plus years experience as an analyst, trader, and teacher. Jeff is also the editor of the monthly Commodity Juncture service, along with Elliott Wave International's educational service, Trader's Classroom. Hi, Jeff. Good to see you.
Hello, Alex. It's great seeing you again.
So I'd like to start off today by talking about the technical tools that you use in conjunction with your Elliott Wave analysis. And I'd like to start off with Trendlines, which you often say are simple but very powerful. So tell me about how something as simple as a line can be valuable with your Elliott Wave analysis.
Of course, Alex. Simply put, if you have a price chart and you see prices moving in, say, a series of higher highs and higher lows, many times what you can actually do is connect the lows on that price chart with a simple pencil and a ruler, draw a trend line. And actually, you'll be surprised at how often when prices stay above that trend line, it's basically telling you that uptrend is fully engaged. Now, when prices penetrate below that trend line, it's often a very reliable signal that that trend is exhausted and a new trend is actually beginning. For a very simple tool, I find trend lines very, very effective. For example, I would recommend anybody listening to this interview take a look at the price chart of, say, the Dow Jones Industrial Average of the advance that has occurred since the 2009 low. You'll be quite surprised how effective a trend line has been during that period.
And expanding on trend lines, you often use trend channels. So talk to me about the benefits of using trend channels in conjunction with Elliott Wave analysis.
Of course. Trend channels, or what I sometimes refer to as price channels, are very important in my work. Moreover, what they actually do is they allow me to identify high probability or high confident trade setups. And the way they do that is because counter-trend price action tends to be contained by parallel lines. So, of course, if I see, say, for example, an Elliott Wave pattern, a zigzag, unfold contained within parallel lines, more often than not, it tends to translate into a very high confident or high probability trade setup. I find price channels very, very important. In fact, it's actually the cornerstone behind my technique called the Kennedy channeling technique. It's a very simple trend line technique that allows you to differentiate between motive waves and corrective waves.
And adding to the list of technical tools you employ, another one you often use is price gaps. So tell me a little bit about how price gaps are important for those who are newer to the wave principle or perhaps technical analysis in general.
Of course. Well, price gaps are actually a chart pattern. It occurs when you have two price bars which don't overlap or the ranges are not included in one another. And what actually, the way it appears on a chart visually is it appears as a vacant space. Okay. Now, there are four types of price gaps: the common gap, the breakaway gap, the acceleration gap, and also the exhaustion gap. Now, from an Elliott Wave perspective, price gaps are very important because price gaps tend to occur most often in the wave 3 position. So many times when you're looking at a price chart and you see a price gap, odds are that it's going to either be a breakaway gap or an acceleration gap. That allows you to identify confidently that price move as a third wave. If that's the case, and if you're familiar with the Elliott Wave principle, you know that a 4 and a 5 will soon follow. In other words, it's going to basically give you a heads up that the next counter trend move unfolding on the price chart will most likely be an opportunity.
Well, thanks for your time today, Jeff. It's always great to get a quick trading lesson from you.
Oh, my pleasure, Alex. Anytime.